finding their footing this morning after a wild ride yesterday, triggered by political uncertainty in Italy. Joining us right now is the president of Yardeni Research, Ed Yardeni. Ed, it's great to see you again.
Thank you very much.
So this week, George Soros said that the European Union is facing existential threats because of Italy's challenge. This will lead to another financial collapse, similar to what we saw in 2006-07. You say?
I think it's premature to come to that conclusion. Italian politics have always been very hard to predict. We've been trying to follow it, and the more I read about it, the more confused I get about where this is all heading.
So what is your take on the global economy today?
Well, the global economy actually looks pretty good. The U.S. economy is doing well. I watch commodity prices, and commodity prices are holding up awfully well. I don't think the price of oil would be this strong if it wasn't for the fact that the global economy is in fact doing quite well.
But does that cut into things? I mean, the oil now at 67.82 this morning. There is a narrative out there that the consumer is slowing down, that we're not seeing as robust activity that you would expect.
Well, I think clearly the increase in oil prices, gasoline prices, is going to take something away from the tax windfall. But you look at consumer confidence, it looks really very, very strong. The employment numbers, I think, are still pretty good.
Ed, just to take a step back on two issues we've been talking about. One, on the Italian situation, do you think there's a 25% chance that we have a kind of a fracturing of the euro?
No, I think the euro is going to survive this. I mean, Mario Draghi said he'll do whatever it takes. And I think the reason the markets are actually rebounding here, or at least yesterday, can't do more than day by day, is there's a perception that now the ECB is less likely to be moving to normalized monetary policy anytime soon, which is another way of saying raise interest rates. I mean, interest rates are still negative over there. And then, of course, the Fed may also be concerned about the global implications of all this and continue to gradually raise interest rates.
And then the second thing that we spent a lot of the first hour is tariffs, trade wars, EU, China. You know, what's your perspective on where this whole idea of where it's going with trade and the volatility it's causing in the markets?
Because we know that the exemptions are finishing. The deadline's up tomorrow. There are new developments. U.S. reportedly going to announce that these tariffs on the European Union go into effect after these exemptions.
Well, look, we've got government by deal making, and what we're not used to is that deal making has been kind of public. Usually a lot of these things get done behind closed doors and the shouting occurs behind closed doors. But this president obviously makes these things very public. And I think the stock market's kind of starting to understand that. And right now it's just kind of zigging and zagging sideways. But I think that these issues are going to get resolved. I don't think Trump is a protectionist. I don't want to shut off world trade. I think he's a deal maker, and I think deals will be made.
Well, the starting to understand it part is kind of interesting because, like, if we were sitting around this table having the conversation, I don't know, maybe a month ago, 2 months ago, don't you think the market would used to react to the headlines right away, and now you know pretty much nothing today. Even though if you had this headline, my point is 2 months ago, you'd see a pretty big sell-off in the futures. Right?
I think engineers talk about a noise-to-signal ratio here, and the signal is earnings. Earnings are extremely strong. The global economy is doing well. Commodity prices are hanging in there. And that's, I think, what the market is increasingly focusing on, because everything else is turning out to be noise. You know, one day it's bearish, the next day it's bullish, and I think the market just kind of...
The reason in the past that you would want to keep these kind of negotiations and fights, if you will, behind closed doors is because when you introduce that kind of uncertainty into the business community, businesses stop making decisions. If they don't know how much their steel is going to cost or where they're going to source it from.
I think that's a very good point.
And so they stop hiring, they slow production. You have farmers across this country, whether they grow soybeans or ginseng in Wausau, Wisconsin. They don't know what's going to happen with China retaliating. So you have Europe, Canada, Mexico, China. You have steel and aluminum tariffs. You have the threat of automobile tariffs. That alone would send up the cost of a Kia maybe $3,000.
Those are all great points. And I think it's why we're going to continue to see the market kind of move sideways here in a volatile fashion, maybe less volatile over time. But the underlying fundamentals, I think, are going to continue to shine through. And I think you could go point by point as you have gone with these issues, but I think overall the economy continues to perform well simply because the U.S. economy is creating jobs, and the global economy is doing fine.
And so far, the business sector has been the stronger part of the economic story.
Well,
so we'll see if businesses change behavior because they've started spending after sitting on cash for so many years.
I think we can't dismiss the fact that taxes were cut rather substantially,
right,
and that $2 trillion is coming back as repatriated earnings. But I think companies may very well hold off on some of the extras. But meanwhile, I think they continue with their business. I mean, you don't just stop doing business because of the noise.
So preview the jobs report for us. The May jobs report coming out tomorrow. Economists are looking for 188,000 jobs added to the economy in the month of May. Unemployment rate expected to hold steady at 3.9%. Is that in line with what you're thinking?
That's in line with what I'm thinking. I think the economy is at full employment. We've got 6 million people unemployed and 6 million job openings. That's usually called frictional unemployment. Either it's a geographical issue or it's a skills issue. But I think the economy would hire a lot more if in fact, we could find the people that we need to hire.
There's a real labor shortage.
There's a real labor shortage, or at least a mismatch, geographic and skills related.
So what do you worry about, Ed?
Well, I do worry about all the issues that we've been discussing.
So like trade.
Trade
is the big issue to worry about.
Trade's a big issue, but again, I think a lot of this is just deal making. Just we haven't seen it this loud, and I think
that would be the worry. If you're wrong, if the president really is a protectionist, you said he's not. That would be the worry.
Yeah, I don't think he is. I think he's kind of more like Reagan on trade than Hoover.
So do you want to put new money to work in stocks right here?
I think every now and then, like a couple of days ago, we get opportunities to buy things cheaper. Even in Europe, some of the banks that sold off incredibly. In fact, they're doing very well.
Ed, just on GDP, where do you see future growth? And where are you on GDP for 2018?
Well, I think I like to look at GDP on a year-over-year basis. That takes care of some of the first quarter seasonal issues we have. And it's really been growing around 2.5% on a year-over-year basis. I don't know that we can do 3% sustainably because I don't think we have the labor force for it. But I think it's the same old consumers.
So then aren't you incredibly concerned on deficits if we're at 2.5% after the tax cuts?
Well, I'm not worried about it yet. I'm sort of fact-based rather than faith-based in my economic analysis. The market just doesn't seem to be concerned about it just yet. I'll be concerned about it when I see clear signs that the market is reacting to the deficit concerns. Right now, the market's not doing that because inflation remains extraordinarily low. Europe can't get the inflation rate up to 2%. Japan can't get it up there. We're at 2% and may very well moderate from there.
But we've been in the markets a long time. When you have low rates and you're forced to go into the markets, then there's a risk on play that's been happening.
Yes.
Then we know that doesn't necessarily dictate where the economy is. The markets don't dictate the economy.
No, but they're part and parcel of it. In other words, there's a feedback mechanism. And, I look at some of these revenue data that the Treasury publishes every single month, and the revenues are coming in pretty strong because people have had capital gains in the stock market.
And especially in the blue states.
Yeah.
How about that? Because of the tax cuts.
Come on, it was
Cali and
right. So maybe it wasn't Armageddon
Come on,
after
I can
all.
debate that
maybe
one.
It
It was
wasn't
all
crumbs
pushed
after
forward.
all. Maybe it actually had an impact and a positive impact. Ed, it's good to see you.
Thank you very much.
Thank you so much for joining us, Ed Yardeni.